Thank you so much for making the time to sit down with me today. Maybe let's just get a sense of you giving us an overview of the bull market that we're in and the direction that you think this is going to go and whether it's sustainable.
Yeah, thanks very much for the question. It's actually interesting, and you know, we're 6 years into this bull market, and it's worth sort of taking stock and revisiting some of the principles of you know, value investing, but also the principles that one would apply in any markets. We typically don't forecast markets, and we don't try and get a sense for where markets are going. We look for opportunities on the ground, and for us, it's been quite an interesting bull market. It's been a very hated bull market, but investor time horizons have definitely shrunk, and we've definitely seen investors have moved into or have had a real appetite for buying some of the low risk parts of the market, and some of the higher risk or perceived higher risk parts of the market have been shunned. And so if you're 6 years in, there are still opportunities out there. Just fewer opportunities than we were seeing maybe 3 or 4 years ago. And those opportunities are often in the more cyclical areas of the market where you've got to take a longer term view. As we said, you know, if investors' time horizons have shrunk, you typically will be buying some of your more higher quality type companies, or you'll be buying bonds, or you'll be buying property type companies. And those have generally been perceived as being low risk type you know, segments of the market. And we challenge that a bit at the moment. And we think that investors are actually paying a very high premium and a very high price for that certainty, because those, you know, horizons have become, you know, quite short. And because you're paying a high price, and the yields on those type of assets are actually very, very low at the moment, and that worries us a bit. But if you're willing to take a longer term approach, there are certain segments of the market where we think now the margins of safety have actually opened up significantly, and that's typically in you know, the areas of the market such as, you know, resources and mining, construction. Within the low risk type categories or low perceived risk type categories, bonds, property, credit, we're just finding few opportunities. Yields are at generational lows.
I want us to get into the resources and construction conversation in a bit, but before we get there, maybe let's also just get you taking us a couple of steps back and just reminding us about, you know, what is value investing and what are the basic or fundamental principles that will underpin value investing?
Yeah, so if you go back to, you know, the first principles, and we often refer to, you know, Charlie Munger, who gives a great example or a great sort of definition of value investing, and he says all intelligent investing is value investing, where effectively what you're doing is you're acquiring more than you're paying. You're buying you know, 100 cents opportunities at 60 cents in the rand, so to speak, and effectively what you're doing is you're trying to understand what underlying security is worth, and you're trying to buy it at a discount. And the principles are quite simple, we think, in terms of value investing. The first is that you should always buy with a margin of safety. So Warren Buffett uses a great analogy when he says you build a bridge that can take a truck or hold a truck that weighs 30 tons, and then you drive, you know, 10-ton trucks through that bridge. The difference between the 10-ton and the 30-ton you know, weight is the margin of safety. So, you know, if you get it wrong, you're typically not going to get it very wrong. The second principle is much more difficult in practice to actually apply, and that's, you know, being fearful when the market is greedy and greedy when the market is fearful. And the market is seen as being a little bit schizophrenic or a manic depressant. Sometimes it's very, very euphoric and paying high prices for certain assets, and the next day it's you know, down in the doldrums and being very, very pessimistic and won't buy assets at any price. And if we look at the market at the moment, we talked about it now, certain of those segments which we think are the more perceived to be the low risk type segments, the higher quality type opportunities in the market, and we're looking at some of the equities, you know, SA Breweries and Naspers and Aspen and British American Tobacco. We think there's a lot of greed there. And conversely, in the mining and resources sectors, there's a lot of fear.
Greg, I want us to take maybe one step further into this being greedy when the market is fearful and being fearful when the market is greedy. And maybe give us a sense of why do investors oftentimes get it wrong? I mean, we're talking about a perception of risk here, and you are turning that perception on its head, and you're saying that the spectrum is pointing in the right direction. Why, in your view, do you think that investors oftentimes get it wrong?
Well, you know, there's basic emotions, and this is the tough part about investing. You know, the market is supposed to be rational, but history has suggested that it's actually not that rational, and there are these periods of wild swings of euphoria versus, you know, depression, so to speak. And it seems that when you have basic emotions of fear and greed, they drive investor perception, and fear hits you right in the gut. I mean, it's instantaneous. share price is falling, it looks like it's not going to, you don't know where the bottom is, you might have lost half of your net wealth, the natural inclination is to be selling. And we're seeing that very, very much so in the resources segment at the moment. And the flip side is, there's a comfort in crowds, and a lot of people are buying those high quality type equity names and bonds and property companies, and you feel good because you're in the crowd, but you're paying a very high premium for that rosy consensus.
What are you saying to your clients who are current holders of resource stocks, who are feeling the pinch of falling commodity prices and the impact of a stronger dollar and the like?
Yeah, I think you've got to take a long-term view. And I think it's very, very important now when you've got to look out over a number of years, not just over the next 2 years. We at PSG Asset Management have been quite light resources over the last couple of years, but over the last 6 months we're buying when the opportunities have presented, and that's typically that's how our process is configured. When there are distressed situations, where there are opportunities where we think we can buy reasonable quality companies at below average prices, we will typically exploit that. So if you're holding those resources companies now, all things being equal, we think those are good opportunities over the long term. The next 6 months, the next 12 months, we're not sure, where those share prices are going to go, where their earnings are going to go, and we typically don't try and forecast that. Yeah. But if you do take a longer term view and you look over 10 years, these type of opportunities often prove to be generational buying opportunities.
Now, earlier in our conversation, you did share with us a couple of stocks that you thought were very expensive, the like of your Naspers, your MTNs, yes, your SABs. Let's talk about the other end of the spectrum. Who do you think are going to be the high flyers in 2015? Who are you looking out for and saying, these are a group of unloved stocks, but ones that we love because we think there's good value to be had here? Yeah,
and I think that's, what I'd probably do is point you towards our top 10, which would be our higher conviction type holdings. Capitec is a good example. I think that's owned across our funds. Back in August of last year, there was a lot of fear around in the unsecured lending market, and it created an opportunity for us, we thought, to buy a very above average quality company at a below average price. But we think, if we look out now, and that from the lows in August, the share price has risen almost 60 or 70%. So it's been a very good contributor to our fund performance. But when we look out over the next 5 to 10 years, we think it's got a great opportunity to continue to take market share. And grow earnings at a very nice rate, and you've got a very good management team, a very strong balance sheet. So we think it's a solid bank with a great opportunity to continue to take market share from some of the big banks out there.
Well, I'm also going to ask you now to blow your own horn for a moment, and perhaps let's get a quick reflection on your performance. How has PSG performed? In essence, the question is, the approach that you described to me now, has it worked?
Yeah, and maybe we can just finish that earlier conversation about getting the odds in your favor. So if you can buy with margin of safety, you can be fearful when the market is greedy, you take a long-term approach, you be bottom up, so you disregard what's happening around you, and you define risk as not losing money rather than underperforming over the short term. Those are the principles that we would use in terms of trying to get the odds in our favor. If you look at our long-term track records, I think we've been reasonably successful. The PSG Equity Fund is actually #1 in its asset class, in its category, the general equity category, since the inception of that fund back in 2002. And it's still the same fund manager actually managing that. So over the long term, I think we've performed very well, and we think we've done it at low risk because our strategy has been quite a simple one: be very patient, but when you get opportunities, you've got to pounce. And we do get these, and we're still getting those type of opportunities. Over the shorter term, and we typically don't look at shorter term performance, our performance has actually been very good. Our equity, once again, our PSG Equity Fund is #1 in the category over the last 2 years, and that's been quite pleasing for me because we've had typically quite a large value tilt in the fund. So the companies that we own typically trade at quite a big discount to the market. So the average P of that fund is around 12 to 13 times, whereas we think we're buying at least above average quality companies. So we think the average quality estimate of those companies is better than the market. But it's been a tough type of environment for the last 3 years for that type of strategy, but we've actually performed very well.
Let's talk about a term that's come up consistently in the conversations that I've had with other people from PSG, and this is your 3M approach. Yes. And how that has fed into the broader strategy.
Yes. So the 3Ms, the definition of the 3Ms is modes, management, margin of safety. We're looking for businesses with a superior competitive advantage. So it's an above average business model, management teams that we'd like to partner for the foreseeable future, and then with a margin of safety. And the stock market's a fantastic place. Every day we come to work, we get to partner and buy great businesses. with great partners. So Berkshire Hathaway is a very good example of a fund that's been in a stock that's been in our funds for many, many years. We've been able to partner with Warren Buffett for many, many years. But to execute on those 3Ms, the moats of the management is a quality factor. We want to buy above average quality at below average prices. You typically have to be buying when there's fear and uncertainty. And that's, I guess, going back to that earlier part we talked about in terms of being fearful and greedy.
Right. Now, today you've had an opportunity to engage with a fairly large audience, sharing with them the PSG outlook. Maybe talk to me about some of the responses that you got from the audience. Was there anything that you walked away with that piqued your interest as you were engaging with the fund managers that were in the room?
Yeah, and there's a lot of pushback on resources. I think there's a lot of negativity around that sector. Investors did come up to us and were questioning, just the overall investment case again in terms of the resources sector and particularly the energy sector as well. Sasol is a company that's a big company, and it's at the forefront of many people's in many investors' minds. A lot of investors also did try to engage us on what's happening in the macro environment, and we typically try and steer away from those type of conversations. If you do take a long-term view, what happens in the macro environment over the short term becomes less relevant, and we try and steer investors back to the basic concept of focusing on a business, focusing on what it's worth, focusing on what you're paying for it, and taking the long-term approach.
I want us to go back on just the importance of a solid management structure within a particular business that you'd look at. To what extent then would you track management changes within a company, and if you felt that the company moved, had a large swing in the pendulum from a management focus and management style and adopted a completely different model, at what point would PSG then begin to review their holding?
Early on. Management is very important. The best way to evaluate management is looking backwards in terms of track record. We typically have a very concentrated sort of portfolio and buy list of 25 companies. So we want to buy very good opportunities, and we want to back very good management teams. And if management does change, we'll obviously want to evaluate the new manager. But if we've got a current manager or a new manager that's got a different strategy, you've got to be very, very careful in terms of what impact that might have on the business. Capital allocation, which is what management's key role is very, very important in terms of driving long-term returns. And how managers reinvest and invest in their businesses will ultimately have an impact in terms of how fast a business will compound in the future. So it's very, very important to keep evaluating management strategy. How well they're executing on that, and if that does change, you've got to be honest. You put your hand up and say the facts have changed, and you need to exit that business.
Have you had to review, a holding on a company of late where you felt that the change in management warranted PSG to review their holding?
I can't think of anything at the top of my mind at this stage.
No. Well, maybe as we begin to wrap up, just get a sense of succinctly what are the key messages that were shared today, and if you could give us also concisely what is the overall outlook that PSG would like to leave with the audience today.
We're still finding good opportunities in the equity market, even though we're 6 years into a bull market. But you have to be much more circumspect and much more careful in terms of where you're looking. Got to make sure there's a large margin of safety, and don't be sucked into what the herd is doing. Try and actually bet against the herd. So we're finding good opportunities in the equity markets, fewer than we were 3 years ago. So we have got higher cash balances. We're finding few opportunities in those perceived to be lower risk type segments. Property, bonds, credit. We're just finding few opportunities there. So we do have correspondingly more cash as well in our asset allocation funds. And I think the key message is that cash is actually a very valuable asset class to have at the moment, because it's going to give you a lot of firepower to exploit opportunities as and when they arise. And we think those opportunities will arise over the next 12 to 18 months. There's going to be a lot of volatility out there. And if you've got cash, volatility is your friend.